Tom's trade rule number 16, hedge only what needs to be hedged. So I'm continually asked, how are you hedging this trade? How are you hedging your portfolio? How are you going to hedge this trade? What do you do if this goes wrong? What are you doing for a black swan event? There's an obsession out there with traders around hedging. But my question to you and everyone listening to this is, what are you hedging? Okay. Hedge the things that need to be hedged. You don't need to hedge every single thing in your entire portfolio. And let's dive into it a little bit more, but not everything needs to be hedged. Some trades may not need to be hedged for several reasons, depending on the trader's objectives, your risk tolerance, the market condition. So the first step in hedging your portfolio, to me, is determining what needs to be hedged. So really, what doesn't need to be hedged? Let's start there. To me, short-term trades. Most short-term trades don't need to be hedged. Yeah, if you're trading NEO or Amazon or Apple over the next 12 to 21 days, you don't really need to hedge that trade. Okay. Number two, defined risk trades. If you're defining the risk, why are you hedging it? So defined risk trades are by nature not at risk of severe losses when they're sized properly. So they don't need to be hedged. Credit spreads, butterflies. If you're nervous and you have a lot of defined risk trades on, that a black swan event tonight, when the asteroid hits Earth and kills everybody, is going to destroy your portfolio, you're sized too big. Most of you that are freaking out about hedging are sized way too big for your account and your individual trades. So number one, short-term trades. I see no real reason to hedge those. Defined risk trades, they're defined risk. You can't lose more than a specific amount. The next one, long options. So debit spreads or long options that you buy, those are defined risk. If they're sized correctly, they don't need to be hedged. You should be able to take a full loss on any options you buy or any debit spreads that you buy. Okay? Size it appropriately for your account, and you don't have to worry about hedging. Okay? And then long-term investments. So if you're holding stocks for the long term, there's really no reason to hedge. Stocks go up over time. There's going to be some dips. There's going to be bumps in the road. There's going to be drawdowns of 20, 30, 40%. If you're in it for the long haul, why are you hedging those particular trades? So if you have no interest in selling them, then don't hedge them either. Okay? I'm going to hold for the long term. I have a long-term outlook on my horizon. There's no need to really hedge. Okay, so what are you left with? Well, really, you're just left with undefined risk trades, naked calls or puts and strangles. For the most part, that's it. You don't need to hedge everything. Well, what about the dreaded black swan event, though, Tom? Well, a black swan event refers to any extremely rare and unpredictable event that has a severe and widespread impact on the financial markets. These events are characterized by their unexpectedness, their extreme rarity, and their profound consequences that they may bring. The term black swan was popularized by Nassim Nicholas Taleb in his book, The Black Swan, The Impact of the Highly Improbable. The word improbable is in there. So going back in history, a 30% black swan is virtually unheard of. I'm not going to waste a ton of my resources every week planning on an asteroid hitting the Earth tomorrow. The largest 2-week drop last year in 2022 was 500 points, or about 11%, and it took 2 weeks to get there. I don't know what you're hedging, but I don't think you really need to hedge an 11% drop in 2 weeks in the market. The COVID drop was about 30%, but it took 4 weeks to drop 30%. And then it recovered almost all of it in 8 weeks after that. If you had hedged it, congratulations, you made some money on that. If you had defined risk trades or long-term investments, you were back to where you were from the day it started in 12 weeks. So you were back up. The global financial crisis of 2008 resulted in the housing market bubble burst and the collapse of several major institutions. It then recovered. So while black swan events are rare, they serve as a reminder that the unexpected and highly disruptive events can and do occur. You should be aware of the possibility to take steps to mitigate this exposure. even though you can't predict how or when they're going to happen. Again, remember, they're extremely rare and unpredictable. They happen once every 10 years or something happens. If you're going to hedge significantly for a black swan event tomorrow, the drag on your portfolio is going to be so severe that you really should probably consider not being invested. If you cannot sleep at night because you're worried about a black swan event, your size too big, and maybe your investing style is incorrect for your particular tolerance. Overhedging. So let's talk about overhedging. So overhedging investments can be detrimental. Several reasons. Number one, increased costs. Every hedge involves costs, transaction costs, fees, commissions, spreads, much less the cost of the actual hedge itself. So when you overhedge, you incur unnecessary expenses that's going to reduce your overall returns. And they add up significantly if you're hedging more than what's required. Reduce profit potential. Hedging is a form of insurance against potential losses. While it does limit your downside risk, it also limits your potential upside gains. Overhedging is going to excessively limit your profit potential because you're effectively just betting against your own investments. Okay. Again, why are you in some of these trades if you're going to bet against yourself? Complexity. Managing a portfolio with excessive hedges can become very complex to manage. Many people have so many different concoctions on there. Oh, I've seen so many different black swan hedge things. I'm going to buy 5 of these puts, sell 3 of these, trade 9 of these. Then I'm going to take some of these off and put some of these on. Holy cow, the complexity of these is amazing. Yet all you're doing is just putting a drag on your portfolio in the case that an extremely rare event might happen. Okay? And you're hedging things that don't need to be hedged. Also, it's going to affect your capital allocation. Overhedging ties up capital that could be deployed more effectively elsewhere. Capital is a finite resource. Tying up too much of it in hedges reduces your ability to size other investments and take and seize on other investments that may offer better returns. And then reduce returns. Over the long run, overhedging is going to lead to suboptimal returns in your investments. You may be better off with another strategy that has a lower rate of return and safer. You might just want to be in T-bills. Maybe you should just be in T-bills earning 5% a year instead of trying to earn 10%, but spending 5% a month on hedging and ending up with only 5% a year anyway. And often overhedging doesn't just align with your goals. Every investor has unique goals and objectives. Overhedging may not align with your specific financial goals. If your goal is capital preservation, overhedging might make sense. But if your goal is to achieve substantial returns, it may not be the most suitable strategy. And if you're trading actively short-term trading, I don't know what you're hedging. Okay, hedging is really for more longer-term investments that you may have that offer pretty much unlimited risk that you have to take care of. Okay, so successful hedging is going to strike a balance between managing the risk and the profit potential. So let's talk about how I hedge. For me, I'm only hedging what needs to be hedged. Hedges are for protection, not income. They're a business expense like insurance. And really, am I looking for a 50% drop tomorrow on a black swan asteroid hitting the Earth? No. I'm really looking for a fast 15% sell-off, typically. Not a meltdown of 20 to 30 or 40% that's slow over months. I don't need to hedge that. Because my style of trading takes advantage of that. If we melted down 20%, and in 2022, it was a nice downward grind down, meltdown. Okay, 20, 30, 40%, fantastic. It was the best trading year I've had because my strategies are built to take advantage of that. So for me, I'm worried about a 15% very quick sell-off. What happens if we drop overnight 10, 15%? If we get a 30%, 40% overnight drop, there's not a whole lot you're going to do, but get into a fetal position, hide under your desk. Okay. The markets typically don't drop 30% overnight, but 10, 15%, sure, that's a possibility. I'm only really hedging my strangles and naked puts, leaps that I might have, and any other undefined risk trades. Okay, that's all I'm looking to hedge. 112 trades in my account are by nature naked puts, but I'm buying or selling the 5 delta, which is about 20% out of the money. So we would have to drop nearly 20% just to get to my strike, I could still take assignment. I could roll them out if needed, or I could just move on and, again, like I said, take assignment and wheel out of those things. Lots of options to do when I've got naked puts that are 20% out. But if I don't, if I'm at 12, 15% on naked options or parts of strangles and we drop, it's going to be a significant hit to the account. I want to be able to hedge that. So I'm really only looking at what am I hedging individually. So you got to determine your hedge level. The bottom line is determine what actually needs to be hedged. As a trader, not everything is in need of hedging. Get over it. You don't need to hedge your entire portfolio. Hedge what needs to be hedged. What are your goals for the trades? What are your stops? If after getting stopped out on your trades that have stops, what's that amount? How can you offset that loss? That's the way I look at it. Okay? If all of my undefined risk trades, which have stops on them, but let's assume that all of them stopped out, okay, what would that amount be if I hit my stop loss? And again, I get it, I might miss or blow through some stops, who knows? But let's assume that not every trade is going to hit the stop, but the majority of them will. So most will hit their stops, will be in a little bit of trouble. If I got stopped out on all my undefined risk trades at my 2x stops or whatever you have, what would that amount be? And that's what my hedging amount is. I'm hedging against getting stopped out quickly in a day or 2 or 3 on the majority of my undefined risk trades. Okay. Determine your hedge level, determine what makes sense for you, determine what makes sense for your portfolio. But my bottom line is to you, hedge only what needs to be hedged. Take care, everybody.